Hey, everybody, I'm David Bloom, co-founder of Next TMT and Next TMT Talks, here with my co-founder, Daniel Frankel, in our weekly, midweek partnership with Media Play News, talking about some of the trenchant issues in the business of media and play and news. It's sort of hard to avoid with a short holiday week, talking about anything but what's going on with Netflix, which had their quarterly earnings on Tuesday. Today is Wednesday. But there's a lot happened in that day. Not only did they put out good earnings, they also announced they had turned their, as had been expected, or at least foreshadowed for a while, had turned their offer for Warner Brothers, not Discovery, but just Warner Brothers, to an all-cash deal by shuffling around some of their debt. They announced a very cool little bit about live voting on a new show that played last night. I didn't get a chance to watch the new reality competition, but it has live voting, and you can do it. You don't have to call into some sort of thing like in the old days with The Voice or whatever.
Mm.
And they're foreshadowing for the year that they're going to be doing a lot more vertical video, a lot more video podcasts with deals with The Ringer and folks like that, Spotify and iHeartMedia, with some pretty good numbers on a couple of the ones that they've sort of opened the door with. And more games, and goodness knows what's happening.
Merger.
Yeah, and it's really kind of interesting to see all that. I was amused to see that among the new movies, not only is there a new expanded Play One window or Pay One window with Sony and live action movies from Universal, but about 20 shows from Paramount, which they're fighting with to buy Warner Brothers. It's like, okay, we'll still do business with you. We don't care. So I was kind of amused by that.
That's an important client. That's an important buyer. I'm not going to just let that go.
Well, it's interesting with all the sort of histrionic language used by David Ellison's team in some of this, that it's like, we'll still do a deal with you.
Yeah, it's not like it's a court battle. It's a not so friendly competition for a prized asset. So,
Yeah, I guess. So we still got to get business done. And so they're going to have about 20 shows internationally in some cases and domestically in others.
all this stuff is happening. It's true. But you had, by all accounts, another really great earnings report from Netflix yesterday.
Yeah,
They
they
hit
they they
every,
stretched the margin, made more money than they made. They're up about 18% in revenue year
right.
over year. That's
They're
pretty
doing
good.
well.
Yeah.
They're serving 325 million customers worldwide. If you factor in family members, hangers on, all audience considered, a billion served. It's an impressive media company.
Yeah.
And they finished the day with their stock down another 6%. This merger is not beloved by the investment community, for Netflix at least.
I think it's safe to say that it is an overhang. That is indeed the word that Tom Rogers used today. He is now a senior advisor to Versant, the spinoff from NBC Universal. Versant, as we like to call it in France. He's a senior advisor to them, but he used to run NBC, and he knows just a little bit about the media business. He calls his a tempered bull, as he put it, for Netflix. He said, look, it doesn't matter. Long term, Netflix is going to be fine, whether it gets Warner Brothers or not. He said, and this is a really good point. He says, like, it's got 7x the EBITDA of Disney streaming right now. It means it's just wiping the floor with Disney in terms of the revenue it's bringing in, the profit margin, it's the earnings it's bringing in after you do all the little Hollywood stuff. And then he says they have a clear path to 40% margin. He says, this makes me feel like the heyday of cable. 40% margin is a pretty good number. If you can get
I know
that.
all of it's true. And the investors
Yeah.
feel like you were doing all this with organic growth, and then you went and messed up the apple cart with this acquisition. And they took on, what was it, $8.2 billion more worth of debt yesterday by competitively upping the ante and going all cash. They have to borrow more money now to come up with that.
Right. Throwing off cash. That's the thing. They're throwing off cash. And I guess the thing that really annoyed investors was, oh, you're going to stop in midstream your share buyback program. They had like an $18 billion plan, and they're partway into that. They said, we're going to stop that, save that cash to pay off the debt and the bridge financing and all the costs around the acquisition. The other thing that I thought was really interesting, and I'd love to get your feedback too, it says, look, Netflix has won the long form battle. They've won, period. And there's a lot, whatever, whether they get Warner Brothers or not, they won the long form. That's not the thing. And at least in the short term, the real problem is the short form video competition is rising up. So that is user generated AI content that costs nothing to make and is just going to be a tsunami of stuff. It is professionally generated AI content that, the movie that used to cost 100 million now can cost 10 million. And all of a sudden you've democratized the means of production in classic Karl Marx fashion. And that opens up a whole bunch of possibilities. Maybe you don't need to have all of Warner's production studios and all of that stuff to create a bunch of content that people will watch because professionals are making it with these tools, leveraging these tools to do stuff. And that's kind of interesting too. And
Yeah,
then
I saw a
finally, the
generative
fast one.
AI demo this morning that showed you could just go through, a company with a decent sized library can just deploy this software and it'll make countless short form profile videos for you. You
Extract
could
clips and post them on
exactly
20 different places and see what works and then A/B test it and see what the language is. Yeah, that
right.
there's already a whole army of these so-called clipper humans doing stuff like this. So AI sort of replacing the clipper
They can go home
army.
now. Yeah.
Yeah, it's going to be really interesting. Then it becomes okay, you're going to take 83 billion or whatever that number ends up being and throw it against this. You could have used that to, I don't know, buy more AI stuff or whatever. But I do think there's a compelling argument to be made personally that 83 billion isn't being misspent. If you do acquire these assets, if you do have this IP, you have something that people will watch even amid the user generated slop, the professionally generated UGC or GC that's made out of AI,
No, I
out
think
of
I
the
mean,
fast stuff that's just leftover things.
it
You
was a
you
big
can do that.
it was a big portion of their earnings call on Tuesday.
Yes.
And Sorando said, yes, at the time before we proposed this deal, we were not into theatrical distribution. True. But with this available to us, it makes perfect sense. We've looked at all of their businesses and we can make more money from them than they're making now. So that makes a lot of sense. So I don't think anybody's disputing the notion that this could be accretive to the business. It's just what they'll have to go through to get it. I looked at their stock price today from just comparing it to June when it had its most recent peak. It was nearly 130 a share. It's down nearly 34%. And if Wall Street's going to react this way, if a stellar earnings report isn't enough to offset the pain, and this goes on for 12 months, 18 months, 36 months, whatever it takes to ward off the world's one of the world's richest men and Larry Ellison and his pockets, do they have the will to sustain that? At what point do they just say, oh, we just can't do it anymore? It's this is such an anchor. It seems to be a question of will and their ability to sustain the stock hit over time.
But the stock hit doesn't matter if the business is still working. The conversation about stock only matters for things like employee stock options, right?
Right.
That's for compensation. It's at a price that's pretty attractive right now for a company that's pretty good, arguably just focusing on the ups and downs of the stock price because the market can be stupid, certainly in the short term. It is absolutely an overhang on the stock. But does that stop what they're doing and keep them from making money? Or does the market eventually kind of go, well, they're still in it and they're still making, they keep raising their margin. And by the way, the price earnings ratio has come down to a pretty good level. You park some money over there and wait for it to pop. Because as soon as the deal's done, either they're kicked out or paid off or give up or complete the deal, the stock will go whenever that is. If it's 3 years from now, it'll go up, whether they win or not.
Here's my question. What will Paramount do next? What do you think?
Well, they've said what they're going to do next, which is they're going to go do the proxy fight. They're going to go and try when Warner Brothers board has to set an annual meeting sometime in the next in the next little bit for
Real
within the
fast,
next
let me
6
clarify why I asked that question that way, because it seems like with with Netflix moving to an all cash posture, it accelerates the timeline for which Warner Brothers meets and agrees on it, right? I mean, that could happen as soon as March instead of much later because it's a more simple deal.
Yeah, I mean, possibly,
Paramount can't
possibly it
stick around.
accelerates that part of it. That's not been the holdup. The holdup is there now are going to be two holdups. One is a proxy fight, which is going to cost some money because they're going to try and get their own board of directors in there, slate elected. That's a tough row to hoe. Just like the hostile tender offer was a tough row to hoe, and sounded like a lot of the big shareholders were kind of saying, we'll put our things over there just to kind of see if we can squeeze some more money out of Netflix. We like Netflix better. Let's see if we can squeeze some more because we think we can make some money off of selling off Discovery separately. That's like two bumps. We get two deals where we get a premium price, a premium price. So I think there's a set of that stuff going on, just gamesmanship trying to maximize the return that they get. The proxy fight. If you look back just to uh, Nelson Peltz and Disney 3-4 years ago, Peltz lost. He ended up pushing the share prices way up from where they were. They were up $25 or something like that a share, and he sold it at a really good premium and walked away with a couple billion. Okay, that's called the kind of losing I want to do. Just saying. But all that, they're going to go do this. It's an uphill battle to try and pull it off. It's hard to win. The side that's ahead will a lot of times the company will settle to kind of make people go away. I don't think that seems like it's in the cards here, but that's what's next. And unless I think that they're going to have to appreciably bump up. And when we've heard this from some of the analysts, they said, 103 for everything and totally discounting any value whatsoever for those cable networks at a time when the big shareholders are kind of going, oh, we got a chance for another nice little payday, maybe 20 billion, 15 billion, whatever it is, another nice little payday. They're going to have to appreciably bump up, not just a buck or two, but beyond 103 to something that actually values that.
Yeah, that's what I was trying to. How far do you think that goes? I guess it's hard to tell.
Well, I don't know. Larry Ellison, richest man in the world, but he's got bills to pay too. Lanai ain't cheap to run. Neither is all the Carbon Beach in Malibu. So he got overhead, and it's what it's worth. Oracle is getting its own shares beat up pretty good. His shares were flying high 9 months ago, and then it looked like they were way out over their skis with debt that they think they're going to get back. Software in general, everybody's going like, I'm just going to have my AI.
I thought I had
code
troubles when
right
my kid asked me to buy him a car. Larry Ellison has this kid wants buy me a media conglomerate. I want it.
Right. Actually, buy me two.
Exactly.
Buy me a sports car and then buy me like a G-Wagon from Mercedes. It's like that's kind of what we're talking about here. Or maybe so anyway, I just think there's just lots to go still. Netflix can be fine long term. If you just want to park your money, it's not going anywhere, that's for sure. If you don't mind sitting there, it's going to pop when it pops.
Might be a distant stock buy right now for the foreseeable future.
Yeah. Yeah, it's a good deal, but it's not gonna do much for a while, so take your pick. Anyway, with that, we should wrap this up. This is David Bloom, co-founder of Next TMT Talks, and with my co-founder, Daniel Frankel, and our partnership with Media Play News and our new midweek edition. You can subscribe to our weekly newsletter and our other podcast at nexttmt.com. That's TMT as in technology, media, and telecom. So Next TMT. Anyway,
As
thank
always,
you guys.
like and subscribe. Thank you. Bye.
Like, subscribe, share, all those nice things. Anyway, bye everybody.